All right, let's get right into it. We're zeroing in on one single event that has the power to completely reshape the global financial markets. And that is, of course, the Federal Reserve's interest rate decision coming this December. Now, this is so much more than just another meeting. The aftershocks from this could ripple from Wall Street to literally every corner of the investment world, setting the trend for months, maybe even years to come.
You know, this image of a giant clock, it's the perfect way to think about the Fed's influence. Every single decision, even a tiny quarter-point change, is like a nudge to that clock's hands. And the result? Billions of dollars can just appear or vanish in a matter of hours. It just perfectly captures this huge impersonal force that we're about to break down. A force that, for better or worse, sets the entire rhythm for the global economy.
So here's our game plan. First, we'll dig into the fundamental power the Fed really has. Then, we're going to look back at history because it gives us some major clues. From there, we'll map out the potential aftershocks for both crypto and stocks, run through 3 likely scenarios for December, and then wrap it all up by building a winner's strategy. The goal here is simple, to go from just understanding to having a real actionable plan.
Okay, let's start with the basics. The Federal Reserve isn't just America's central bank. Let's be real. It's basically the central bank for the entire world, since it controls the world's reserve currency. Its influence over the global economy is, well, it's almost absolute. It is the hand that moves billions, steering the flow of all that capital with every single word and policy change.
I want you to think about interest rates like a giant door that controls the flow of money. It's a simple idea, but it's incredibly powerful. When the Fed cuts rates, that door swings wide open. Capital gets cheap, borrowing is easy, and money just floods into the markets looking for a home, looking for returns. But when they raise rates, that door starts to close. Money gets expensive, credit gets tight, and that flow of cash can slow to a trickle, and it often just suffocates asset prices. That's the dynamic that controls everything.
And that brings us to the million-dollar question, right? Will they cut rates this December? The U.S. economy right now is in this really weird, half-hot, half-cold state. Inflation has come down from its crazy peaks, but it's still kind of sticky, still above their target. The job market looks good, but you can see some cracks starting to form. So any misstep by the Fed right now could either spark inflation all over again, or, just as bad, push the economy into a recession. The stakes for this one decision are just extraordinarily high.
You know, if you really want to get a sense of where we might be headed, you have to look at where we've been. The Fed's past moves give us a blueprint, not just for what they might do next, but more importantly, for how the markets are going to react. In finance, history doesn't repeat itself exactly, but boy, do its patterns and rhythms give us a guide.
Just think back to the classic taper tantrum in 2013. The Fed didn't actually do anything. The chairman at the time, Ben Bernanke, he just mentioned the possibility of maybe slowing down their asset purchases. Just those words, that's it. And it sent global markets into a complete panic. Stocks plunged, bond yields shot up, and money just fled from emerging markets. This event teaches us the #1 lesson. The market moves on the anticipation of what's going to happen.
This is a core principle. I mean, every seasoned trader gets this. The market prices in what it thinks is going to happen way, way in advance. The real action, the real fireworks, that happens when the decision finally comes out. And it either confirms what everyone was expecting, or, even more dramatically, it completely contradicts it. So understanding what everyone else is thinking is just as important as the event itself. And right here, you can see in black and white what happens when you get that expectation right versus getting it very, very wrong. Back in 2018, a lot of people were betting the Fed was going to pause its rate hikes. Well, they were wrong. The Fed kept tightening, and both the S&P 500 and the crypto market got, and I quote, crushed. Now compare that to 2020 and 2021. The people who understood the Fed was going to keep rates at basically zero saw some of the biggest gains in history. I mean, Bitcoin's insane surge from around $3,800 to $69,000, that was almost entirely fueled by this policy. The lesson is brutally clear. You either align with the Fed or you risk getting run over.
Okay, so this is where it gets really interesting. This is the core of our analysis. If the Fed does pivot, if they cut rates, what are the specific aftershocks going to be? How does this one decision start a predictable chain reaction, a domino effect, across everything from crypto to stocks? First, you absolutely have to understand what crypto is at its core. It's a child of liquidity. See, unlike stocks that are tied to things like earnings and cash flow, crypto's value is super sensitive to capital flows and just general sentiment. It loves cheap, abundant money. When money is tight, the crypto market basically goes to sleep.
But when the Fed opens the floodgates, it doesn't just grow, it explodes. It is the market's ultimate risk-on canary in the coal mine. And during a bull run that's fueled by all this easy money, the capital flows through the crypto market in a pattern that's become pretty predictable. It always starts with Bitcoin. Why? Because it's the most liquid, it's the easiest for institutions to buy. Then, usually about 1 to 3 months later, once confidence is high, the profits people made in Bitcoin start to rotate into the higher-risk altcoins. That's what kicks off altcoin season. And finally, in the craziest, most euphoric part of the cycle, that money looks for the biggest gamble, fueling the meme coin manias.
Now, how does this compare to the stock market? Well, in some ways, it's night and day. Crypto's reaction is immediate and explosive, and it's driven by raw liquidity and good old-fashioned FOMO. Stocks react fast too, but it's a much more measured response. See, a rate cut boosts their valuations by making future earnings more valuable. So while stocks can have significant upside, the smaller, more retail-driven crypto market, it can see moves that are 5 to 10 times bigger, but of course, with way more volatility.
This shows you just how connected all these global markets are. It's like watching a set of dominoes fall. A Fed rate cut kicks off a chain reaction. First, as rates fall, existing bonds that have higher yields become more valuable, so their prices go up. This makes the US dollar weaker because capital starts looking for higher returns in other countries. A weaker dollar historically is great for hard assets like gold and Bitcoin. Then stocks rally, thanks to cheaper capital and better sentiment. And finally, once that risk-on feeling is everywhere, the most speculative assets are the last to catch fire.
Okay, so with all that in mind, let's look ahead. We're not here trying to predict the future with 100% certainty. That's a fool's game. What we're doing is preparing for the most likely possibilities. So let's break down 3 core scenarios for the Fed's December meeting and what each one means for our strategy.
Think of this table as your cheat sheet. Scenario A, we'll call it the bull run. The Fed actually cuts by a quarter point and boom, you get an immediate positive market reaction. Then you have scenario B, the slow burn. Here, the Fed holds rates steady, but they signal that cuts are coming soon. This leads to a more gradual rally. And then, there's scenario C, the deep freeze. The Fed holds rates but comes out with a really tough, hawkish tone, basically saying they're still worried about inflation. This is the one the market is afraid of, and it would likely cause a pretty sharp sell-off.
All right, so this is the most important part. How do we turn all this analysis into a concrete plan? This is your playbook for navigating what's coming. Because, like we've said, it's not about predicting. It is all about preparing.
So a smart portfolio leading into a big event like this looks something like this. You have a solid core of Bitcoin and Ethereum, an allocation to some large-cap altcoins, and, this is critical, a 10 to 20% position in stablecoins. That's your dry powder, it's your defense if things go south, and it's your firepower to jump on opportunities. But the most important number on this chart is right here, 0% leverage. Using margin before an event like this isn't investing, it's just gambling. Don't do it.
Your action plan is simple. It's 3 phases. Before the decision, get your portfolio set up strategically. During the announcement, that first hour of pure chaos, you do nothing. Seriously, the biggest mistake people make is reacting to those wild initial swings. Let the market breathe, let it digest the news. The real opportunity comes in the 24 to 72 hours after the announcement, once a clear trend starts to emerge. That is when you act. That is when you deploy your capital with conviction. It all comes down to one of the oldest and wisest sayings on Wall Street, and it's an adage for a reason. Don't fight the Fed. The investors who got wiped out in 2018 fought the Fed. The ones who made a fortune in 2020 aligned with the Fed. You just don't bet against the people who control the money printer for the entire global system. It is a battle you are not going to win. And look, when the stakes are this high, our own mind can become our worst enemy. You have to avoid these traps. Don't FOMO into some speculative altcoin before there's a clear signal. Don't go all in on one thing. Resist that urge to trade like a maniac during the chaos of the announcement itself. And once the market has decided on a direction, respect it. The trend is so much more powerful than your opinion.
And this leads me to a final, really important point. Even if the Fed stays tough in December, a pivot to easier money is, well, it's inevitable. With the amount of government and corporate debt out there, today's high interest rates just aren't sustainable forever. So a bull run isn't a question of if, it's a question of when. Our job isn't to perfectly time the start, but to be ready for its inevitable arrival.
At the end of the day, this is the core philosophy. Success in these markets doesn't come from having a crystal ball or being the smartest person in the room. It comes from having a solid plan, staying disciplined, and understanding the big picture forces at play. In the long run, preparation will always beat prediction. You know, in every market cycle, there are people who get swept away by the current, and there are people who learn how to ride the wave. The difference is vision, it's discipline, and it's preparation. A new financial wave is forming right now. The only task left is to be ready for it.